Um, isn't okay. Um, so so far we've covered some fairly important principles, an understanding of which I hope has given you at least a little more clarity on how the market actually moves. And we started last week by looking at the basic structure of a price swing. So this idea that price moves between phases of consolidation in which the majority of volume is traded, and impulse or imbalance. So wide-ranging illiquid moves which often leave behind kind of weak legs in price, areas in which liquidity is thin. We also went over flag limits and why they occur, and why I consider them important, as well as what to start looking for when price starts ranging or flagging out. And that is consumption, basically, some sign that either buyers or sellers are beginning to dry up. Okay. So now that we've laid a foundation in terms of market mechanics with this emphasis on efficiency and inefficiency, we're going to look at the structure of a price swing in a little more detail and go over how and where you can actually get into a trade based on this understanding. And the title of this webinar is Market Structure, Engulf and FTR. So I'll start by explaining those terms a little bit, but I don't want to spend too much time dwelling on that because the names really aren't important. They're just terms I use, just shorthand for phenomena which occur in the market. Okay. And as always, if you've got any questions, feel free to just jump in the chat. Okay. So what do I mean by market structure? When I say market structure, I'm simply referring to the framework in which price moves, and that framework is kind of defined or contained by liquidity. So let's start again by looking again at a very simple representation of a pricing, just so I can explain the basic concept. And I'm going to use this gold chart again because it's quite kind of clean. But just before I start, I should note that when I'm marking up a chart, I'm always going to start by looking at the higher time frames so that I know what kind of trade I'm taking. So that I know, am I trading with or against the higher time frame flows? Do I expect continuation or reversal? How long should I be holding this trade? And I'll go into a lot more detail on this in the webinar on scale and managing expectations in a couple of weeks' time. Okay. So just bear that in mind. But for now, we're just going to focus on a price swing like this, devoid of context, basically. So when price is moving up, it's generally making higher highs and higher lows. It's a little more complex than that, but we'll stick with this for now. So quite simple. And as I explained last week, pockets of liquidity get left behind in these areas as price moves up. Okay. So if price is kind of bullish, in other words, if we don't have any significant selling, if there are still enough buyers in these areas to support price when it retraces, like it does here, okay, price moves out of station it retraces and finds support, because there was some liquidity, some residual liquidity in this area. Okay, so if there are still enough buyers in these areas to support price when it retraces, we expect these areas to hold and for price to continue on up. So that's market structure, and a break in market structure occurs when price breaks this trend, when those areas start to fail or get engulfed. And I looked up the definition of engulf, and it means to surround or cover something completely, to eat or swallow something whole, or to powerfully affect or overwhelm someone or something. So thinking in terms of liquidity, it might help to think of it like this. A break in market structure occurs when limit buys in an area like this, for example, when limit buys in an area like that start getting consumed or overwhelmed by the sellers which have come in at the top here, and are now going to start chasing price down. So that's essentially what I mean when I say engulf. Highs or lows, and specifically the pockets of liquidity which are supporting or constraining those highs and lows, when they get broken. And as I explained last week, it's the market kind of tipping its hand, a heads up that in this case, when price breaks through this area of liquidity, that buys are weak, and or we're starting to get some significant sellers coming in. So as I explained last week, I'm paying very close attention to the structure which I perceive to be holding price up. In this case, this flag limit here, okay, illiquid move, price pauses, consolidates. There are limit buys in here, residual liquidity, price flags out on top of this area. And when it breaks, I'm anticipating that price will continue in the direction of the break, because that for me is a sign that, as I say, buys are now weak, and we've got sellers here. And once that breaks, this structure right here is what I'm looking for. The failure to return in the direction of the prior trend. Okay. FTR. So price breaks this flag limit. The last low before the high. So it engulfs the buy side liquidity in here, which was holding price up. It stalls here, this pocket of liquidity, and then it retraces or consolidates for some time before breaking down again. And it's when this low here, the low before this kind of paused or consolidated, it's when that low goes that we can say that price has failed to return. Okay, and then we can mark that out. That's your FTR. And I don't really like the word trend, and that it will become clear why, but you could think of it as kind of confirmation of a new trend. And now we get the same thing in reverse. Lower lows and lower highs. Sellers moving down with the market, and buy limits, buyers getting taken out and or unwinding their positions. So quite simple stuff. Anyone got any questions about that so far? Okay, if not, we'll just move on. And one thing to note is that these structures, these FTRs, failures to return, they come in all different shapes and sizes. But this is the gist of it. Let's say we have a barrier here, okay, a pocket or base of buy side liquidity. Could be a significant swing low or some clear SR, which, as I'll explain, is simply an artifact of liquidity anyway. But at some point, price will break or engulf this barrier and either consolidate or retrace what's often a fast or illiquid move until it finds some sellers and starts breaking down again. And as I say, this retrace comes in all different shapes and sizes. But if this is your barrier, let's say the lower boundary of the pocket or base of buy side liquidity, which has just been broken, the retrace or consolidation, it could look like that. Could look like this. Okay. Could look like this. But whatever the structure looks like, once it breaks back down below this low, okay, finds sellers and breaks down below the low, or even better, breaks down below whatever structure this found support at, okay. Once it breaks back down below that, we can say that price has failed to return, and what I'll do is mark out this entire structure. Okay, so whatever it looks like, that's your FTR. Sorry, that's a little messy, but the gist of it is this. Because price found resistance here, that suggests to me that there was liquidity somewhere up in this high. Why? Because otherwise price would have just carried on up. Market will move until it finds enough liquidity to satisfy the demand of buyers. So the deepest retrace on any move, okay, deepest retrace, that's important because we know that's where there was liquidity. If sellers didn't come in up there, price would quite likely not have stopped. So it's as simple as that. So those are the areas I'm generally looking to take trades at, and I'll explain why. So you're all well aware of what happens when price moves out of balance, especially on a break of significant areas of structure. So areas which other market participants use as points of reference or triggers for action, whether that's forced or unforced. So areas of classical support and resistance, or swing highs or lows, right? So when price breaks down through these series of lows, there's often a highly inefficient price run during which, as I've explained, spreads widen, stop loss orders get triggered, aggressive sellers will push price quickly through what's often an absence of buy side liquidity. And I've already explained that the nature of these moves means that price will very often pull back to fill in this leg, regardless of whether or not we get any significant buying coming in down here. Okay, so in other words, if price moves quickly out of a base like this one, you know, you get this inefficient leg in price. It doesn't take much buying for price to pull back to an area of more significant sell side liquidity. So something like this, these are your low volume pullbacks, and you shouldn't be afraid to trade them when you think you've got a good read on which way price is heading. And I'm just going to show you what this looks like on the cumulative volume delta, because it's another quite useful way of visualizing this dynamic. So this is Bitcoin, and down at the bottom here we've got the cumulative volume delta, and all that is the ratio of market buys to market sells in any given candle. Okay, so say you've got an hourly candle, and within that hour there were 100 Bitcoin bought at market and 100 Bitcoin sold. The delta would look like that. Okay, it would be flat because there was an equal number of market buys and market sells. And if you had 100 Bitcoin bought at market and only 10 Bitcoin sold, let's say, it would look, let's say, something like that. Okay, so it represents the ratio of market buys to market sells, and you know, vice versa. If more Bitcoin had been sold at market than bought, if 100 Bitcoin had been sold and only 10 Bitcoin bought at market, the delta would look like that. Does that make sense? Okay, great. So the cumulative volume delta tells us something about the density of limit orders in the book. For example, if you've got let's see, if you've got a large delta like this one here, we know that there's been a lot of market buying there, but if price remains relatively flat, okay, if the hourly candle looks something like this, let's say, then that suggests to us that there are a lot of limit sellers in here. Okay, because we know we had a lot of market buying and yet price didn't go up, basically. Similarly, if we have a very, if you have a very small delta and price moves a long way, that tells us that the limit order book was likely quite thin, because it didn't take all that much buying for price to push up all this way. Okay, so we use the delta to inform ourselves about the ratio of market buys to market sells, the aggressiveness of buyers and sellers, and two, it contains some important information about the density of the limit order book. So just to give you an example from the chart here, massive down candle, not all that disproportionate to the amount of market selling which occurred there, but not all that much market buying in the next few hourly candles, and yet price retraces the entire move. Okay, so that tells us that this move was a liquid because it didn't take all that much market buying for price to retrace almost the entire move. Similar here, okay, big down candle, lots of selling. The next few hours, there's not all that much market buying, and yet price retraces the entire move. Okay, so we know that this move was illiquid. And the same down here again, lots of market selling, not disproportionate to the kind of move we get there. Relatively weak buying here, and yet price retraces that entire move. And it's not a surprise to us that this move was illiquid, because look where it occurs. This happens on the break of market structure, basically. Areas where we've got stop loss orders, aggressive sellers, an area in which market makers are quite likely to stop providing liquidity and or widen the spread. Okay. So I hope that's clear. And the point I'm trying to make is that it always comes back to the same thing. Where is there liquidity and where is there not liquidity? This is an example from FUSD, I think, on BitMEX, which demonstrates this dynamic quite well. So just note the series of higher highs and higher lows on this run up here. Okay. Price breaks this low here, the last high before the low. Sorry, the last low before the high. It retraces, and then when it continues to break down, that's your FTR. Okay. So once price continues to break down, it finds support where at this pocket of liquidity down here. It retraces again where to the last FTR up at the top here, before breaking down through the buy side liquidity, which was supporting price, and into this thin or weak leg in price. Okay, an area in which we don't expect much liquidity. And it's worth noting that the nature of a move like this, okay, it means that liquidity is likely quite thin on the sell side, at least temporarily, okay, because it's an illiquid move. And so that's where price will go. It will retrace here because price pushes to the less liquid side of the market, okay? But of course, if the higher time frame flows are still down, if there's still liquidity pooling somewhere above market up in this FTR, okay, high, low, that low gets broken, price retraces before continuing to break down, okay? So if there's still liquidity pooling somewhere up in here, in this case, up at the top here, up at this untested portion, then of course price will simply carry on down once it hits that liquidity. I hope this isn't too confusing, but hopefully it should become clear. So, you know, this is how I view the market. If price has taken out this buy side liquidity, okay, there was liquidity pooling there, but not anymore. It's been consumed or engulfed, and you know, price hits some significant sell side liquidity. Okay, and I'll explain where in the FTR liquidity tends to pool in a minute, then, you know, what we have here is space for price to move. Okay, this liquidity has been consumed. There's fuck all in here. Okay, and we've got fresh sellers up in here, so price has space to move from the fresh sell side liquidity up at the top of this FTR to the next area of buy side liquidity, which will, you know, is down in here somewhere. Okay. So once price takes out that buy side liquidity, I'm waiting for price to retrace to an area where I expect there to be sellers waiting. And once it hits those sellers, now which side of the market is the most illiquid side of the market? Well, it's down in here, okay, because as I say, the buy side liquidity has already been consumed. And so when price responds at resistance at the top of that FTR, sellers are going to start chasing price down, and price will move down until it hits the next significant area of buy side liquidity, which is down at the bottom here. Okay, so I've got a question. After it consumes the bottom liquidity, the next move to the downside doesn't move as low as the wick that cleared the liquidity. Wouldn't you expect that to immediately move down rather than retracing to the FTR? Do you mean, wouldn't I expect this move here to carry on down past this low? It all depends on context, to be honest. I mean, I'll explain in a minute why there tends to be liquidity pooling at an area like this, which is why price responded there. And that is one of the areas I often look to trade. Okay, so within this FTR, this right here, more often than not, there'll be liquidity pooling an area like that, and price does respond there. And you know, sometimes price will immediately move down past that low and into this gap here. But number one, generally I tend to like trading the extreme. So more often than not, I'll wait for the extreme of the FTR to be hit. Number two, you can trade this to try and run price down past this low immediately. And that's where trade management comes in. Okay. I don't want to get, you know, I don't want to make it too confusing right now, but on the very low time frames, you'll have some market structure in here. Okay. In this case, this little pause of consolidation, which you can see gets broken here. Okay. So if I were to run it low, that's where I'd be cutting it. So for me, trading is quite dynamic. It's important not to be kind of obstinate or stubborn. You know, you can trade areas like this, because you're right. You know, I wouldn't expect there to be much in there, but you know, when price starts pushing back up here, that's cause for concern. Okay, so I mean, it's not a particularly easy answer, because trading in this way is a kind of dynamic process. So yeah, so sometimes it will run down past that low immediately, and other times it's going to retrace to find more sellers. But hopefully, as the weeks go by and we add more and more to this model, you'll have more tools with which to kind of know when to expect a more significant retrace and when not to, and when to take trades at areas like this and when not to, depending on how price approaches. Okay. And this example right here is a good idea. A good example of why it's a good idea to be trading with the flow. So when you see buy side liquidity breaking and sellers chasing price down, generally that's the direction you want to be trading. Most traders spend far too much time focused on trying to predict where the move will reverse, but more often than not, let's say, okay, right, market structure here is bearish. Okay, price is breaking buys and these highs are holding. Okay, let's say you want to buy this fresh pocket of buy sell liquidity. It's okay, it's against the kind of flow here. Okay, because currently these lows are getting broken and highs are holding. The market structure is bearish. You know, you can still take trades at these areas, kind of counter trend, because more often than not you'll get a response. But for me, it's more intelligent to be looking for shorts on a retrace, trades with the flow, with the expectation that a level like this, these levels will continue to fail as price moves down in search of some more significant buy side liquidity. Okay. So not to say you can't take trades at these levels under the right circumstances, but it's really all about managing expectations, by which I mean knowing where or when to take profit. And we'll come on to this in a few weeks, but the fact is that, you know, in this case, because we're expecting this FTR to hold, okay, you have room for a trade from here to up in here. Okay. I would rather be looking for shorts in this case because our expectation is that this area will fail. Okay. So you basically have more room to run price down. Okay. If you're buying this, you really don't want to be holding past the last FTR here. But if you're selling up here, because market structure is bearish, we know buyers are weak and sellers are chasing price down. I expect this to get broken on the next test. Okay, so you've got more room to run price when you're trading with the flow. So the risk reward on shorts is a lot better. Yeah, Eugene, I'd rather use these as kind of target levels than buying them here. Eugene's asking, how can we measure how much liquidity is left on a very bottom on a first move if we know that buyers were chasing price up? I'm not quite sure I understand the question. I mean, generally, if the level's fresh or untested, like see this little pause here, price shot out and never came back, you can expect there to be residual liquidity there, and the same here. Okay. But you know, once this level's been tested, kind of once, twice, that's starting to look weak to me. But you know, the fact is, we don't really have a measure. But with experience, you'll come to have quite a good idea of when a level is starting to look washed out, when it's starting to look weak. So before I enter a trade, I'm assessing whether or not the trade will have room to run. So space to move into. So again, in this case, although this buy side liquidity hasn't been engulfed yet, price has come down and tested it. There's a gap in here. A short up here makes sense because price has room to run. Okay, I don't expect much buy side liquidity to be left in here, and as I say, there's fuck all in there. Okay, so price has room to run, space to move into. I also want to know where I'm getting out. So Eugene, based on your understanding of liquidity dynamics, you want to have some expectation for price. So a forecast for price action, which includes identifying areas you expect price to move through with relative ease. So these tend to be, weak or thin legs in price, areas of low volume, and areas at which you expect price to stall or even reverse. And those are your higher volume areas, areas where you expect liquidity to be pooling. And once you've identified where you want to get in and where you want to get out, you have to decide whether or not the trade is worth taking. And for me, if the risk reward is unfavorable, there's just no trade there. And that's why it's so important to decide on entry and exit before you take the trade. Because once you're in it, what you'll find is that your emotions will take over and you'll become kind of blind to obstacles in the way of price because you're hoping that your trade will work out. Something called confirmation bias, but we'll talk a little bit more about that in the webinar on psychology. So there'll always be potential obstacles in the way of price, in the way of you and your target. So coming back to your question, Alex, a large part of trading involves paying attention to how price trades in relation to these obstacles, because as it moves, price will generate new information, and so the probabilities are constantly shifting, and managing your trade in relation to these probabilities in real time really requires an understanding of how price should move between areas of liquidity and illiquidity. That makes sense. But it's a skill which takes time to develop, just like you develop any other skill. So don't worry too much about management for now, because it's something we'll talk a lot more about in the coming weeks once we've covered the basics. Anyway, with all this in mind, where exactly do you get in? Price has taken out the nearest buy side liquidity. There's empty space for price to run. Where am I looking to take a trade when price pulls back to this relatively large structure up here? As I say, a large part of the way I trade revolves around the way in which price moves into a level. And we'll get into this in a little bit more detail in the webinar on anticipating volatility, in which we'll look at factoring in exactly how price trades into a level, so the approach. But for now, I'll just focus on the level itself, and then we can move on to the other stuff in a couple of weeks. So okay, once I've identified the area which I'm interested in trading, okay, this quite kind of broad FTR, I'm going to pinpoint prices at which I expect there to be liquidity. And there are a few different areas. First, I'm looking for the point at which price left with good momentum, the point at which a large order or influx of orders came into the market to drive price down. In this case, up in here. And depending on the structure, that area, the pause or consolidation before price broke out, that might be at the top of the FTR. It might be at kind of at the bottom, like it is here, or it could be somewhere in the middle. But from my experience, you can generally expect liquidity to be pooling there. And the reason for that is, okay, let's say our buys down in here. Buy limits start kind of moving up with price, okay? And each time price comes down, it's consuming those buy limits, okay? And so when price is testing this low here, which we know we have buyers at, okay? As it is pausing or stalling or consolidating there, consuming the residual buys at this level, what's happening is that sellers who are chasing price down from up here, there are sell limits basically kind of accumulating in this level. Does that make sense? So sell limits backing up while price consumes the residual liquidity in this low here. And then when price breaks down through it, some of these sell limits remain sitting at that level. And that's why you get this response here. And I'll just demonstrate, I've got quite a nice example from the Ethereum Bitcoin pair on BitMEX. Alex is asking, so basically people who were sell limiting at that area didn't get filled as people market shorted. That's right, yeah. There are lots of different traders, all trading on different time frames with different parameters, many of whom will be using algorithms to kind of structure their trades. And they all have, as I say, different time frames, different parameters. So some will be happy to just sit there until price retraces. Others have a sense of urgency for whatever reason, and that sense of urgency can be kind of programmed into algorithms, and those algorithms will switch from passive, so just placing sell limits in the book, to aggressive, so they'll start selling at market if price starts moving beyond a certain kind of threshold. Just the same as a person would do, right? You might want to get filled, so you're sitting in the book, but when price starts moving quickly, you might just want to jump in, and so you'll market short it. So you've got different players, some of whom are really aggressive and a market shorting as price breaks out, and the rest of those sell limits just kind of sit in the book there and wait for price to retrace. So here, for example, low, high, price breaks down past this low, so that's your FTR. When price retraces, where does it find resistance? At this structure here, the area from which price broke out of this FTR. Okay, low, high, price breaks down through that low. When it retraces, this is the area at which price finds resistance. Okay, the pause of consolidation from which price broke out of the structure with good momentum. Low, high, price breaks down, and then in this case, the area from which price left this FTR is up at the top here. Okay, so that's where the sellers are, and you can see it finds resistance there. And so you can see that when price breaks down, it's not it's not some SR, which, I mean, I don't know how you draw support and resistance here, something like that maybe. It's not that level at which price is finding resistance. It's this, the structure which on the lower time frames we know there is liquidity pooling at. Okay. So, I don't know how you draw the SR here, something like that. It's not the SR, it's the low time frame level, okay, before price kind of broke out of this structure. And yeah, most of the time it won't, but even if the FTR, that consolidation takes the form of some quite clear kind of range with well-defined or apparently well-defined edges like that, even if it takes that form, typically there'll almost always be a kind of low time frame base or consolidation at the bottom here before price broke out, which forms because price has to pause there while it consumes the remaining liquidity at this level, and as it pauses there, you're getting sell limits backing up behind price. And that's the area which I think you should have marked out, not this SR level, because that's where the liquidity is, not some random line. Okay, so if the conditions are right, and I'll come on to that in a couple of weeks, but if the conditions are right, I'll often look to take a trade in or around this breaking point. Okay, that kind of area which formed before an influx of orders came in, which took price out of the consolidation. So around that breaking point. In this case, in a scenario like this, you've also got the order flow of trap traders on your side. So traders who will have been buying the bottom of this range and are likely going to be selling looking to sell their positions at or close to break even as possible. Okay, as well as people looking to sell the retest. Okay. So that's one of the areas at which I expect liquidity to be pulling and which I'll often trade. I'm also marking out the last untested portion of the FTR. So right at the top here, you can see that price consolidated and then it shot out and it never came back and tested that area. And this is generally where I prefer to trade, and I'll explain why in a second. But first, I want to show you a video of Bitcoin from a while back just to demonstrate what these areas look like. Whoops. Okay. So this is the FTR I'm looking at. Okay. Low, high, price broke down through that low, paused or consolidated before continuing to break down. Okay. And on the left here, we've got book maps. So this is just the heat map. And remember that, the more intense the white or gray, the thicker the liquidity at that level. So this just a kind of visual representation of the order book up in here. And so it's quite useful because you can see exactly where the liquidity is pooling in this FTR. So you've got some at 10,930, which is in this area here. Okay, the area from which price left that FTR with good momentum. Let's just play this. You've got some up at 11,000. Okay, that's the very top of the structure. Okay, so you've got some at this untested level here and at the top of that structure. And then if I zoom out, you can see that the bulk of the liquidity is sitting up at 11,200 to 11,260. So that's this level here. Okay, the extreme of the FTR. Excuse me. Let's just go back. The extreme of this FTR. Okay, and there's still some sitting in this area here. Okay, the area from which price left this FTR with good momentum. So the kind of structure which is limiting this flag or FTR. Okay, so bookmap, you can quite clearly see liquidity pooling at the area from which price left with good momentum. The for fuck's sake, the extreme of the FTR and this kind of little nugget or pause in price which this FTR was finding resistance at. Okay. And as I say, the top of the FTR is generally where I prefer to trade. The reason being that I'm looking to get in as close as possible to where I'm wrong on the trade. Okay. Okay. In other words, I like to trade the extremes. What I used to do was get in as soon as possible if I thought I had a good idea where price was heading. But through kind of engaging with price, I realized that more often than not, I was getting squeezed. So I was almost always getting in too soon. And so even if the trade went on to be a winner, my maximum adverse excursion or MAE is a really useful stat to keep track of. My MAE was often relatively high. So so yeah, I kind of refined my entry process and started trading at the extremes, which was really difficult at first. But trading at the extremes of market structure has a number of benefits. The first is that you rarely have to suffer drawdown. You know immediately whether you're right or whether you're wrong. Okay. And you know, drawdown, the psychological drain of which will often, that drawdown, you know, can very easily warp your perspective and cause you to make irrational decisions. So yeah, trading at the extremes, you know very quickly whether or not the trade's going to be a winner. The other benefit is that you can get really tight entries, which give you a favorable risk to reward. Everyone familiar with the concept of risk reward or RR? Yeah, okay. I imagine most of you are. Alex says that the amount of trades I puked that would have been winners because of heavy drawdown is sickening. Yeah, it's torturous, isn't it? Some people can handle it, but a large part of trading is getting to know your own kind of psychological profile. And yeah, for me, I just can't handle it. And a lot of traders are afraid of keeping their stop so close to their entry, because of course you risk getting stopped out very quickly which isn't nice, of course, because it kind of feels like you're just throwing away money. So trading with tight stops can be quite challenging, and there are, of course, size issues as well if you're trading with size, but that can be mitigated with time frame. But yeah, trading with tight stops can be challenging if you're not used to it, because most people will fear taking a quick loss, basically because they lack confidence in their system. But the probability of a trade working out is quite independent of the distance between where you enter and where your stop is. So the stop doesn't go where you're comfortable; it goes where it will provide you with the maximum risk reward without kind of materially affecting your win rate. Okay. So what you should be looking to do is minimizing your risk and maximizing your profit potential without compromising too much on the win rate of your setups, and that's the key to expectancy. So, for example, I used to mark out kind of blocks like this, and then I would trade the bottom of it, but I found that more often than not, price would kind of squeeze to the extreme, and so it makes no sense to me to enter here with your stop up here when more often than not price is going to move up to the top of the structure, and you can get a much tighter stop without materially affecting your win rate. And similar, if you've got a structure like this, you enter here with your stop up here, but more often than not, you find that when price comes up and tests this area here, that's where it responds. Okay, maybe 1 time out of 10 it will come up to the top here, but let's say 9 times out of 10 it responds at this structure here. It makes no sense to keep your stop up here, even though that might be kind of comfortable, because you can keep it down here, as I say, without materially affecting your win rate, and massively increase your risk to reward. So yeah, that's the key to expectancy. And of course, it's easy to kind of say this all after the fact, but actually trading it is a different matter. So it's really important that you become skilled in actually identifying these structures in real time, and that will build confidence in your ability to hone in on potential turning points in price. So Alex is asking, is there not a danger though that the closer your stop is, the more likely it is to be hit through some kind of random noise? Yeah, that is the risk, but the idea is you want to find a compromise between your win rate and your risk to reward. Okay, so of course, if you keep a tight stop, you're going to get stopped out more often than you keep a wide stop. But the idea is that if you can find, if you can start to hone in on these kind of levels, the levels I've been describing, you'll find that very often they hold. And yes, you are going to get stopped out by quote unquote noise more often than you would if you kept a wider stop. But for me, the payoff's worth it. Yeah, that's right. Winners are bigger due to position size increases. So yeah, the first thing I'd recommend you do is go back through sequences of price action using the replay tool on TradingView, or the replay function on Sierra charts on whatever pair or pairs you trade, and just look for these structures, and don't just take my word for it. Trading this requires practice. So once you've identified the structure, look at where price reacted. Okay. So this is some price action on cable, just for example. So what you want to be doing is looking for these structures. There's the high, there's the low. Price broke out here, so that's your FTR. Where did price respond? The area from which price left with good momentum. High, low, price broke out. When it retraced, where did it respond? The consolidation before price broke out of this structure here, this FTR. Again, high, low, and through this process, you'll come to see these nuances. For example, price broke out, but it retraced very quickly here, and so in this case, maybe you wouldn't look to be trading this area here, the area from which price broke out of this FTR. Maybe you want to wait for the extreme, okay, which is where it responded here. So yeah, that's what I'd recommend doing. Looking for these structures and just verifying where does price respond, and the same on gold here. So there's your flag limit. Price breaks down here, pauses or consolidates before continuing to break down. Two areas I'd look to trade. One, the area from which price left this consolidation. In this case, there's no response there. To the extreme of the FTR, the last untested portion of the FTR. Okay, and so you can see that it's often worth waiting for the extremes here, because you can get really tight invalidation. Okay, so this is your low, this is your high, this whole structure is your FTR. When price breaks down, comes back for an immediate retest and tests the area from which price broke out of this structure. Okay, so this is likely weak now. Okay, so but it is what holds price. Okay, comes back, tests the area from which price left with good momentum, and then continues to break down. But next time price comes back here, that's been totally washed out. Okay, there's no more sell side liquidity in there. So next time price comes back here, it's likely going to push all the way up to the top of that FTR. Anyway, the point is it's a good exercise to kind of track price, to look for these structures, and see for yourself, where did price respond. And once you've grasped these concepts and become familiar with the kind of levels at which price tends to respond, at which liquidity tends to be pooling, then it's a really good idea to start engaging with price on a regular basis. And by that, I don't just mean, look for stuff or watch. Most new traders will spend far too much time kind of just watching price when they could be actively practicing. Okay. I use this metaphor in the last round of mentorship, but if you want to learn, something like the piano, you don't just watch the piano, you play it. And it's the same thing with trading. When you're not actively trading, just pull up a 1 minute chart on a liquid pair like Euro USD or whatever it is you trade, and track how price moves between liquidity. Mark out as price is moving where you expect price to react, and take paper trades at those levels. Okay, take trades on a demo account, or even with very tiny position, just so that you can get a feel for what it's like to trade those levels. But it's really important at this stage to not focus on making money. Okay, because having money on the line when you're learning and practicing will interfere with your capacity to see things clearly. Okay. So make a prediction and you know, then observe how does price react at the levels. Did it do as I expected? If not, where did it respond and why? And I'll just go through the that kind of process now so that you get an idea of how you might want to follow price, using an example I used in the last mentorship. Yes, Alex. Yeah, these dynamics play out on all time frames. I mean, the example I'm going to show you now is USD JPY on the 1 minute chart. So if you've got a really liquid pair, yeah, you can become familiar with the way in which price moves or behaves by tracking it on a time frame as low as the 1 minute. You know, not that I'd recommend trading that, but yeah, you can look on the low time frames just to get an idea of how price kind of moves or behaves, and to get a feel for these levels. Let's just bump up the quality, and this is sped up already, I think, but um, we'll just speed it up again. So this is just a video of me marking out levels on a 1 minute chart of USD JPY, recording of something I did in the last mentorship. So tracking price in the lower time frames, which is what I recommend you do. And what I'm doing here is just marking out these pauses in price. Okay. Untested pockets of liquidity which get left behind as price moves down. So I'm marking out what I perceive to be, you know, untested or relatively fresh levels. And note that as price moves down, these levels are holding. Okay, price isn't breaching them, so the market structure is bearish. They're getting lower lows and lower highs. And what I'm waiting for in this case is for these levels to start breaking, and that's when we can start looking for longs. So I note there price fully consumes that level, so that's weak now, and so I think having seen that this week, and I think it actually breaks here. There we go. Take that level off, and I start marking out levels that where we can look for longs. Okay. So now we've got space. Now that next pocket of sell side liquidity has been consumed, we've got space for a trade from this buy side liquidity down at the bottom here to the next area, which is sell side liquidity up in here. Note this gap here as well. That's illiquidity. Okay, and so when price moves into that area, it's likely going to move through it quite quickly. So price holds at the buy side liquidity down at the bottom there. You can see that's the low, and price kind of shot out of the area without coming back and testing it. So the kind of area which I'd expect there to be residual liquidity. So just taking its time here. Before finally breaking out there. Okay, so now we've got our first bullish FTR. Okay, high, low. It's broken through that high, so I'm marking out the extreme of this structure with the aim of longing down here. Okay, the idea being that I've removed that because that quite small level, that level's already been spiked there. Okay, so it's likely quite weak, and so when price responds down here, it's likely going to move up to the next area of sell side liquidity, which is up in here. And you see it, it pushes up there quite quickly. And now I'm just repeating the process. Okay. High, low, price breaks that high. I'm marking out the extreme of this FTR. Okay, that's your FTR. Price has spiked that liquidity once, so I've deleted that level. The idea being that price has room to run now from the buy side liquidity down in here all the way up to the next area of fresh or untested liquidity up in this tiny kind of pause in price up here. We get a kind of triangle structure here. I'll talk a little bit more about that next week, and why price tends to move out of these structures quite violently. There's no sell side liquidity in here, and so price moves very quickly up through it, and quite quickly consumes this minor level here. Okay, so once it's broken that liquidity, where's the next buy side liquidity? It's down in here. Okay, that's your FTR. High, low, price has broken that high, broken through the liquidity which was holding that structure down. Okay, so that's the most recent FTR, and just repeating the process here. And note, first sign of weakness, buy side liquidity getting consumed. And price is also at the top of this swing here, so more inclined to look for short. So what I'm waiting for is those pockets of buy side liquidity to start failing, just like I wait for sellers to start and getting engulfed down at the bottom here, down at the lows. And when they do, I mark out the last area at which I expect there to be sellers waiting, because we're now clear to short from up here to down in here to the next area of fresh buy side liquidity. And also just note, within this FTR, there are multiple points at which liquidity is pooling. You've got the area from which price broke out of that structure, which you can see is supporting price there. And then I'd also expect some down at the bottom there. So you might consider this a kind of flag limit, right? The structure which is quite clearly kind of containing or supporting this consolidation here. And I'm just getting rid of that level now because it was tested there and is now now starting to look quite weak, and you've got untested sell side liquidity up in here. Okay, so room to run price down from up in here all the way down to the next area of buy side liquidity down in there, the extreme of this FTR. And there's a kind of thin or liquid move here through which price should move quite quickly. So that's a nice setup. Okay, and price is just pausing there as it consumes the remaining liquidity. And there's the breakdown, and you can see how fast it moves, and that's totally expected as a result of this move up. And price hits the next area of buy side liquidity down at the bottom of that FTR. Kind of consolidates for a bit here, and then I think it starts just retracing this move, which again is illiquid, and so price shouldn't have a hard time moving through that. Anyway, of course, this is all in hindsight, but I really just wanted to give you an idea of the kind of exercises you could be doing to become more familiar with the kind of structures I'm talking about. Okay, how you should be tracking price, and if you track price in this way, pretty soon you'll start to kind of internalize these price behaviors, and you'll develop a more intuitive feel for the way in which price moves, how it moves between areas of liquidity and illiquidity. And it's so important, in my opinion, that you move away from kind of rigid mechanical approach to trading price action, and begin to develop this kind of relationship with price, because there's no right way of marking out levels. You'll find your own style based on your own development as a trader, a style which kind of has to be consistent with your own unique psychological profile. Okay, and through this process, you'll hopefully develop the confidence to start taking trades at these levels, and to be able to execute with consistency and without emotion, because by practicing, you'll have seen the same thing play out hundreds or thousands of times. And so what you're doing when you exercise price like this is slowly kind of inoculating yourself against the emotional discomfort associated with uncertainty. And in trading, what you don't know represents risk. And so the more you can become aware of, both in terms of price and the way it moves, and in terms of your own psychology, how you interact with the market, the less surprises there are when it comes to actually executing trades. And as I say, through this process of tracking price action, even if you're not trading it, you'll come to understand both yourself and the market a lot better. Okay. But as I say, there are so many details involved in the process of trading, and trading these structures, which you almost certainly aren't aware of, and which I can't really teach you in a webinar, simply because there are too many, and because it's kind of difficult to structure a lesson like this around so many different variables. And it's often in those details, it's those details which can come to define the success of you as a trader. And it's why you simply can't copy a system or set of rules. So whatever markets you trade, it would be great if you could examine your charts with what I've talked about today in mind, and find things which don't make sense, or which you don't understand, which aren't clear to you. So find those nuances, and then sometime next week I'll do a question and answer, so that we can go through all your questions together, and hopefully kind of fast track this process of you becoming familiar with those subtleties in price. Does that sound okay? So just have a look at your charts, find these structures, find anything which you might have questions about. Take a screenshot with a question, send it to me over the next few days, and then we'll do a Q&A next Friday. and yeah, hopefully become a little bit more familiar with price. Okay, so that's all for today. Sorry for rambling on. I hope it's been useful and not too confusing. And even if it has, we'll clear all of that up next week. Okay. Okay, guys. Have a great weekend. I'll speak to you next week.